Hello, and welcome to Fireside with a VC. My name is Andrew Romans, and we're lucky today to have Jack Leeney join us. Real fast, I think I met Jack. I think I met you the first time when you were head of US investing for Telefonica Ventures. Is that right?
Yep, absolutely.
Going back a couple of years. And Jack impressed me because he's not just joining a 40-year-old VC fund right out of MBA and continuing to burn the hedge fund money or pension fund and endowment money that somebody else raised. But he's a fundpreneur, meaning he's an entrepreneur that started his own VC fund, 7GC. And these guys are up and running. And I think they're almost ready to be looking to do fund two, lucky enough to have had some early exits. So Jack, welcome to the pod. Thanks for joining us.
Yeah, thanks for having me. Great to catch up.
So Jack, why don't you give us a quick background? Maybe I'd like to talk a little bit about the Telefonica background and maybe dive into some corporate venture capital stuff, because having been there as long as you were and interacted with a lot of others, I'm sure you've got a lot of ideas of how they could be doing things better or differently, or what they do that they're getting right. I then want to get into the 7GC story. And you and I have been talking a lot off of this about Spacs. And so I think a lot of people want to understand what a Spac is and how they work and do they make sense and how do they work. So maybe we can dive into these topics. But so kick us off, Jack, and tell us a little bit about when did you start with Telefonica Ventures, and from when to when were you doing that?
Sure. So I was running Telefonica's US portfolio from, I believe it was 2011 through 2016 altogether. It was just about 5 years all told. And I had started with more of a traditional kind of corporate finance background. I was at Morgan Stanley in New York, and then Menlo Park. Worked at another firm on Sand Hill Road, but then entered corporate venture kind of by happenstance.
And you've
Which
done a
was
bunch of
fascinating.
IPOs though, right? Like I think you were like in Pandora and LinkedIn, or am I getting that wrong? Weren't you on a
Well,
whole
so
bunch of like venture-backed
yeah,
deals that exited?
yeah. So when I was at Morgan Stanley, it was kind of before, during, and right after the last financial crisis. So we had a front row seat to capital markets opening back up, and basically this huge wave of venture-backed companies all hitting the markets at the same time. So when I was there, Tesla, Pandora, LinkedIn, Ancestry.com, it was the whole cavalcade of a really Sand Hill Road backed firms all hit the market at the same time, which was pretty interesting because it's somewhat similar to what's going on today, but in a very different flavor.
Yeah, and I went through an IPO myself in like the dot-com craze, and I remember I couldn't believe these investment bankers wanted to allow themselves to get liquid instantly on a company that I started and lock me up for 18 months after the listing. What was the average lockup? Because that was kind of second time around when you were listing those guys. And I know John Kraft really well, and he's told me a bit about the inside of. He failed to meet payroll 22 times at Pandora, by the way, before you guys listed them. I mean, so it's like a real grit story. But what were the
Yeah,
lockups for founders when you were IPOing those guys?
I mean, in general, for founders and inside shareholders, it's more or less 12 months. Um,
Okay.
and the interesting thing is that actually, as a legal construct, is negotiated, and that there's no real legal reason or SEC reason why that has to be the case. It's more market standard,
Right.
and something public market investors expect. And not to jump the gun, but that's kind of one of the interesting features of the SPAC. The SPAC lockup can be shorter if the stock performs. So you can have sort of vesting thresholds for lockup as well, but in a traditional IPO, it's just a legal clause that really comes into part of the prospectus.
I mean, I was way more of an asshole back then than I am now. In my kind of late 20s, early 30s, thinking I was worth $500 million with my own startup. But these lawyers were sitting down with me with Morgan Stanley, the investment bank, and Morgan Stanley and Dean Witter Private Equity put 50 million in right before the IPO to be the top of the liquidation stack, like no Chinese wall there. But they
Uh-huh.
told me, Andrew, if you're seen as the founder to be divesting shortly after the IPO, everyone assumes you know more than the outsiders on the street. Like you've got the insider information. that would be a bad signal. Therefore, we want you to stay in for 18 months so we can go upgrade our house in the Hamptons and all that. And I thought it was just very offensive. And 18 months turned out to be a very long time for me in the .com crash.
You know, it's a double-edged sword. This gentleman who just stepped down from Nikola basically took all his chips off the table, quite visibly and quite famously a few months ago. So I don't know. Look, I think there's logic to these constructs, and you know, if you're an agent, you're always going to figure out a way for yourself to get paid first. And if you're a principal, whether it's an investor, founder, late shareholder, and it's you know, these things always have to be navigated. But I don't know. Look, I think the concept of vested lockups to me makes a lot of sense, because stocks are by nature should be pretty turbulent in the first 6 months, for whether it's positive or negative.
Yeah. Well, you know, we didn't have, I mean, by the way, Mark Andreessen was famous at the time when he and Jim Clark listed Netscape. Apparently it was Mark Andreessen's father in Ohio or Indiana that said, you've got to sell something right now and secure this family. And he sold like a big chunk of his Netscape holdings, and everyone was against it. I remember personally applauding it when he did. But I want to get into SPACs first, but you're now playing in the secondary market with 7GC. So there was no secondaries before. And sometimes you even get hit with these tax bills with options and warrants and stuff. Have you seen more people selling on the secondary market right going into an IPO, or hang in there for the entire IPO process and the lockup, even if it's 12 months?
That's an interesting question, and you know, the first thing that came into my head when everything went upside down in March was, this is going to be a great opportunity for secondaries, and I had thought there would be way more dislocation, and the primary markets wouldn't hold up as much, and you know, lo and behold, March was an aberration, and we're, you know, back in the bull market like it never even happened.
Yeah.
But look, I have a fundamental view that whether it's in LP stakes, direct stakes, that the concept of secondaries in venture capital is just completely broken. It's absolutely broken, where, you know, the basic requirements for having some sort of a functioning market outside of volume and interest, you know, buyers and sellers, is there has to be transparency, and there has to be full access to information. And, you know, at Series D share with a ton of pref and different terms on it is not the same as employee common that can only be transferred once. And Black-Scholes isn't going to price that. And, right, you know, these are very nuanced situations. And look, if it's Facebook 6 months before it goes public, if it's Uber 12 months before the valuation has stayed flat, sure, blocks of this stuff can move around. You can organize tenders, employees can do stuff like that. But like outside of those minute scenarios, and also outside of those minute scenarios where the value is only appreciating, so the company doesn't hate it conceptually, this doesn't make sense. And all of these marketplaces or brokerages that have popped up to facilitate it, I think is like the Wild West. And for that reason, you know, sometimes we're a buyer.
Okay.
I think like the way we look at it is, you know,
can I just step in, Jack, for our listeners? So we're talking about secondaries. And so what that means is that if you're a founder or an investor, the two kind of definitive liquidity events for the company are a mergers and acquisition, M&A, sale of the company, where you're selling or merging and getting stock in something else or cash. And then the other one is an IPO, and you survive a lockup, and now you're selling shares on the open stock exchange. Secondaries is trading of shares on the secondary market, where companies still private, and either founder, early investor, even last in investor decides to sell some of their shares at a gain or a loss to another buyer. So I just want to make sure people know what we're talking. We got into that kind of fast with some jargon. Just wanted to clarify that.
Yeah, no, absolutely. And I think the only thing I was going to elaborate on is, you know, most firms or most funds have a relatively straightforward investment criteria, investment thesis, and that usually means, you know, if you're early stage or you're late stage or whatever it might be, certain things. And you know, for us, we kind of look at it a bit differently, or maybe more even the way a hedge fund might kind of look up and down the cap table. I'm asset centric. You know, we're looking for the best mid-stage growth assets where we think there's at least 3, if not 5x, with kind of nearer term liquidity, nearer term in context of venture. So not 10 years, maybe 3, 4, 5 years.
Okay.
And to that end, whether, you know, most of what we do in the portfolio is, you know, direct primary growth rounds, working alongside other big investors, working directly with management teams. But you know, on the contrary, very open to secondaries. If we see a big pricing dislocation in a great asset we like, very open to buying potentially a busted LP stake if there's a big concentration in the landmark asset. Starting to look at things really differently on the late stage and on, you know, the Spac topic and more to kind of think about there. But I've always thought there's not a lot of creativity in venture capital as an asset class, where people in the fact that people kind of stick to their knitting and do, you know, if you're a Series A guy or gal, you know, that's what you do and that's where you play, and you sort of stay within that and kind of focus on that universe. And we kind of look at it the other way around, sort of unbundle the products and just look at asset quality, and is there hopefully an ARB you can get from kind of depackaging some of that process.
I think the secondary market evolved quite a bit. I even spent a couple of years where I had to even get under FINRA 7 and 63 and 79, where I was brokering secondaries. And I loved it at the beginning and I hated it by the end, where I think you're well positioned to be able to be a primary investor that brings your European LP base, which we can talk about later, to add value. But when it's a non-value added buyer, they end up, you've got a right of first refusal. And at first, to your point, VCs are like, oh, I'm a Series A, Series B gal. I don't do secondaries. I don't even believe in it. And so they weren't exercising their preferred shareholder rights of having a ROFR, a right of first refusal. Then they started waking up to that. We can increase our ownership target percentages of these companies, and we'll discount common to preferred if there's a big liquidation stack above it and where they are in the waterfall and where the risk is of getting out. But we started seeing somebody like Industry Ventures would come in and say, we want to buy a big secondary of one of the founders' shares, or an early fund that wants to sell 20% at a huge gain. And then it goes around to the preferred shareholders, and they have 45, it used to be 90 days to exercise their right of first refusal or waive it. And they started doing SPVs, like special purpose vehicles, to their LPs, saying, do you want to match Hans? And so Hans at Industry is like a stock, like, you know, he's just setting the price. You know, he's the horse setting the price for the insiders to give it to their LPs with really light economics on what they're taking, or even vicious economics. The other thing I'll say, and let's move on maybe, is I've seen some crazy structuring of secondaries where someone says, look, I know this Palantir is going up every 6 months by this much. And this is actually a true story from Palantir. This guy, I won't say his name, but he's building a huge house in Park City, Utah. And he needed to pay a builder only so much to keep them building this monstrosity for the next 6 months. And he knows 6 months later, the stock will be up this much because he's on the inside. He doesn't want to sell more than he needs to pay the builder. And literally was cutting to deals that says, I'll sell at this valuation, which is higher than the valuation should be, which signals to the market that Palantir is valued at X when it's not. But if the buyer makes it 2X, he's going to give 80% back to the seller and get 20% of the upside after getting his 2X. So you could do anything with price it below or above where it should be, and then say, after I make this kind of return hurdle, we'll split upside in any way it could be negotiated. So talk about creativity and venture. It was like too much.
But that name specifically, if I'm not mistaken, is pretty nuanced too, where you can trade the stock twice only. So it doesn't have sort of full transferability. There's like, it transferred once and it transferred twice. And then the last person holding the ball was kind of stuck, from the way I remember it. So you had basically like Class A shares and Class B shares, and different price for that, given, you know, perceived liquidity. So yeah, it's, I mean, look, I think it all goes back to the point is, even if there is volume, even if there is a good amount of buyers and sellers, which I think in venture-backed companies is extremely rare. There's
Yeah.
5 companies that matter in a given moment where there'll be institutional volume. Then the next thing that's crucial is just this transparency, access to information, and kind of governance. And none of these securities are the same. They're all nuanced. They generally come with, completely opaque disclosure or access to information. And it's an interesting space. I'm honestly surprised it's gone on this long, because I didn't think there were enough names to really support enough volume. But it's definitely bespoke trading for sure.
Well, I think there's levels of like people don't have access to any of the financials. No one, the seller doesn't have any kind of information rights, and Pinterest is a phenomenon, And so, there were a lot of people that are just willing to get into a phenomenon like Facebook, Pinterest, Tesla before they list. Whereas I think there's a big opportunity for people that are not just some broker dealer out of Chicago, but people who really know what's going on in the Valley that can get into secondaries when they make sense. But let's talk about, and I'll say one last thing, like advice to entrepreneurs. I have a buddy who founded a company, got close to an exit, moved to actually the Lake Tahoe where I am right now. But he was in an Incline Village to be on the Nevada side because he doesn't want to pay tax on his big exit, which is a lock-in. The exit falls through. Years go by. He's now left the company, and he tried to get me to help him do a secondary, and because his life was falling apart, and he didn't have information rights. And it wasn't a phenomenon, Pinterest, but it's a damn good company. And there would have been buyers for it if I could have produced the financials, and they'd price it. And the current board hates him now, and he was unable to do a secondary, and he ended up getting divorced. And I know the whole family, and it's really tragic.
Oh no.
So, and then the exit came not that far after the divorce, and now he's loaded rich. But who wants to be rich and lose your family? You know what I mean? So secondary, it's a complex thing. So my advice to founders is it's counterintuitive when you're the founder and you're doing your Series A with Benchmark or Jack Leeney here, but ask for permanent information rights. So even if you exit, you're in a position to do a secondary. You would never think of that when you're going up on your first or second round. But let's switch gears totally, and not totally, and talk about SPACs. So a lot of people are talking about SPACs. It reminds me a bit of some of previous history. But Jack, can you explain for us what is a SPAC to begin with?
Yeah, absolutely. Happy to. So as I mentioned to you, I have been serving on the board of a SPAC for the last year that announced their business combination, and the SPAC is called PropTech Acquisition Corp, and they've merged with Porch.com, which has been a fascinating experience, really a front row seat to the whole product, and very educational because, when I mentioned I started out, way back when at Morgan Stanley and in a capital markets capacity, SPACs were really rare and a bit of a kind of a niche product you never really heard about. You never heard of TPG and Apollo doing a SPAC, that's for sure. And that's the world we're living in now. I mean, SPACs now are half of all listings this year and 40% of all dollar volume this year.
Whoa.
in what has been a super, so the secret's out. There's about 35 billion of SPAC capital in search mode right now. So it's gotten incredibly active. And there's a lot of acronyms, a lot of buzzwords. Sometimes they're called blank check companies, but the easy way I like to think about it or describe it to people is it's basically like taking a private equity fund public, going to public shareholders, raising money on a thesis, saying, we are Seven Global Capital, we invest in late stage internet businesses, and we want to raise a fund from public market investors purely under that thesis. So you do that whole part first. Roadshow, the whole shebang, stock trades, has a ticker, quarterly filings. But all of the money you raise on the roadshow sits in a trust, sits in a bank account, and is essentially waiting there until you find a target. Now, the difference between a private equity fund or a venture fund and a SPAC is with a SPAC, you're really only looking for one asset. In theory, you could do a multiple asset combination or kind of a platform play, but the vast majority of SPACs, it's a merger with one business, a private business, And when the SPAC, which is really just an empty holding company with a bunch of cash, merges with private company XYZ, the SPAC structure essentially falls away. All the cash goes to the balance sheet of the target company, and that company becomes public, almost in like a backdoor way. So, publicly traded private equity fund is one way I think about it. From a target company point of view, the way we often describe it is a pre-sold IPO. So it's already gone public. It's already gotten the shareholders. It's articulated this thesis. You merge with it. The transaction looks and feels way more like an M&A transaction. It's privately negotiated. You come up with valuation in between two parties. The board agrees. You know exactly where you stand. This is, there's a lot just being talked about and written about them these days. But Bill Gurley had a great piece actually advocating for the product, which was great to see after he's been such a champion of direct listings. But the big advantage from a founder's point of view is I think a couple of ways to look at it. First and foremost, you can do a SPAC IPO in 2 months. And that's through, provided accounting diligence goes smoothly, like public company accounting diligence, which is quite the X-ray, and also SEC review. But from getting to a deal, negotiated, board approved, and actually trading, you can be as quick as 2 months. Anyone who's been through the traditional investment banking process, from pitching them or the other way around, I mean, we all know this is a year in the kind of best case scenario, good market conditions. So speed is definitely there. And look, the second most important thing, there's obviously been a lot of discussion around mispricing or underpricing IPOs, and tons of money left on the table, all these big stock pops, Snowflake and Zoom, and lots of them, is you can control your own destiny here. This isn't an agented transaction by Morgan Stanley, Goldman Sachs. This is a principally negotiated transaction. Target company and sponsored, private equity SPAC. So where the stock ultimately trades and how it moves is, really you've determined your own fate. It's not a book build on the last day. When the businesses combine, the market cap has been predetermined and set. And look, the market will determine if you were right or wrong, obviously, once the stock's out there and research picks up and there's volume traded, et cetera. But I could go on and on with some of the nuances of the product, but it's incredibly interesting. And frankly, I understand why it's gotten so popular. I'm a bit biased. I'm a bit close to it. But the interesting thing is, what we're seeing right now is, my opinion is, the venture ecosystem is a bit late to the party, or kind of just coming online. The vast majority of SPACs on the road right now are being run by middle market private equity sponsors, individuals who've had really, really illustrious operating careers, but they're in all sorts of different sectors that are non-IT. It's financial services, real estate, industrials, really, more the value-oriented side of the market, I would say. And it's been very exciting to see now that, the light has gone off on Sand Hill Road a bit, and there are more and more venture firm-led, growth firm-led SPACs going out and filing, and also more and more venture-backed targets going public through SPACs. So right. I think it'll be interesting, and I think it's something that's been necessary as in the wake of what's been just total madness in late stage private markets for the last 5+ years.
Yeah, I mean, I think if you look historically, what's happened is we had the late 90s with the dot-com boom and the golden telecom days, where anybody was going public before they had revenue or revenue model. Like they were talking about what eyeballs, or what was the term people were using for, page views. But, and then that crashed, and that crash was so severe, we got Sarbanes-Oxley. And then we went through this really ice age of nobody going public. The four horsemen like H&Q and Montgomery Securities got bought up and ruined as they got the good people left, and they just got sucked into Chase and big banks. And so we lost the kind of IPO machine of the venture capital asset class, giving birth to really great entrepreneurs. And then, and then we kind of see big IPOs come, but the threshold for the IPOs and I want to talk about what is kind of top line revenue got to be. Is there you probably don't need profitability, or what are the metrics of what you got to get away? Because it kind of got to the point that no one would IPO you for less than 250 million top line sales with like your Goldman,
Yep.
JP Morgan, Morgan Stanley. And then the other thing is, like Tim Draper was complaining that the initial cost of an IPO is $6 million, and the cost of annual compliance post Sarbanes-Oxley was around $6 million. So those economics are not going to be justified if you're not of a certain size. So what is the cost of doing a SPAC? 2 months is an amazing timeline, so that's cool. What's the total expense of doing it? And what are the general criteria that the gatekeepers, as it were, impose on you to be able to get one away?
It's a great question. It's a great question. And look, I think it speaks to the opportunity. So right now, the median market cap for tech IPOs is around 3.8 billion. If you were talking about back in not even the late 90s, just 10 years ago, the median market cap for stuff that got out in tech, and this is assuming growth tech, attractive kind of internet software companies, that median market cap was 450 million. So what's happened to small and mid cap names? It's kind of crazy to think portfolio managers at mutual funds or hedge funds aren't interested in smaller high growth stories. It's crazy because we've seen them drift into private markets to get their hands on them. And that's really where the gap is. I think the bar for a traditional quote unquote high quality IPO has just gotten way too out of reach. And there's this giant gap in the market for these smaller mid cap names by public market standards. And it's been completely replaced by private capital. The number of unicorns in this time period, it's just literally one is flipped from the other. It's a zero sum game, and all it's turned into is lack of liquidity and kind of also lack of access for currency. I mean, a million reasons why you'd want to be public. But anywho, look, to your point or to your question, what does it take? I think my sense is it's hard to put black and white figures on it, but there is a kind of tangible scale number of, what's predictable and scalable revenue. And I think in tech and IT, you're seeing companies between 50 and 100 million do SPAC IPOs. I think there are companies with strong fundamentals below the top line, very different bar of quality or, growth versus sustainability required with a public market investor. But without a doubt, companies with strong margins and, call it 75 million revenue line and a good growth story. And look, I think, look across public multiples, and these could be companies, internet companies that have been public for 20 years, or even some of the more recent darlings. Growth, 20% growth year over year is compelling for a public market company, especially a large scale public market company.
I mean, not every one of our companies is doing that, but that's below average for us, That some of them didn't do so well in COVID, and some have gone nuts with COVID with, 100% year-on-year growth, right?
Without a doubt. And I think coming from a venture mindset, you're so used to swinging for the fences and 2x performance year over year or 3x. That's not reality. Or that's reality to get something to a scale, and then it's kind of growth at a reasonable price or sustainability. And can you create this strange thing called net income? So this I think where the SPAC is able to normalize all these things is, look, the Snowflakes and the Unities of the world are always going to have basically all the options on the table. And if they'll want to continue working with some of the most prestigious investment banks, and they'll have insatiable market demand just because the asset quality is so high. Start to think downstream a bit. What about companies that have 100 million in paid in capital? They've been around for 10 years. There's a good scaled business there, call it 100 million, 120 million in revenue. And it's just no longer the shiniest penny anymore. And maybe the investors have said, look, we're not going to keep piling money into this. Get yourselves to profitability or be able to kind of control your own destiny. And that's a great asset. And it's probably got an incredibly sticky customer base, and it's probably got great market positioning. And public market investors have no access to a company like that as a result of the dislocation of the last, 5-10 years. So in my mind, this is where SPAC is the solution. You know, you can do a direct deal with a sponsor. It looks and feels like a private equity M&A transaction. Ipso facto, you get a huge financing to your benefit. And now you're a public company with access to currency. And I think this is really a result of sort of what's happened in the last 5-10 years with just exuberance in private markets.
I think it all ties together with, you know, the market crashes and the rise of the secondary market. I remember when it was quite a few years ago, but when Lyft did like a $350 million financing that might have even blown up to 600, I can't remember. And you saw Carl Icahn and Fidelity
Yep.
plowing heavy money into that. And that was a signal to me of, all right, so there's so much stay private longer, stay private forever, plenty of secondary money around. Who even wants to go public became fashionable. And so these kind of public IPO people that have maybe unfair access to the initial public offering before mom and dad kind of get in there, they weren't getting the bump anymore at the IPO. So they realized we've got to come in lower. And in my early days as an entrepreneur, 350 million market cap on the NASDAQ was a victory, where now it's like,
Sure, totally.
you know, young people in bars in San Francisco are not impressed that you're not a unicorn and you're still privately held. So I think it's good to have a return to having a currency, being able to benefit from buying a company that makes sense. And it's like a creative free acquisition and all that stuff that you don't get as much on the stay private forever thing. So, okay. So listen, that's cool. We'll maybe come back in 6 months and see what people are saying about SPACs,
Sure.
in there. But so I want to make sure we don't miss out on what you're doing now. So when did you start raising 7 Global Capital, 7GC, and what was the initial thesis, and how have you evolved with your kind of fundraising trail?
Yeah, absolutely. Absolutely. So we got going. This was a bit of a conspiracy, or at least we quit our jobs just about like exactly 4 years ago. So it was the end of 2016, and we had this idea. And you know, my partner at 7 Global spent like 15 years at KKR, and he's based in Germany. It was between Germany and London, and the point being, effectively a European perspective, but also fascinated with accessing, you know, really the best quality technology businesses in the world, which really, you know, I think the US still has a bit of a stranglehold on that space if you look at it from a growth and liquidity point of view. And so, you know, he was looking from that way in. I was looking at from a bit of another perspective, where I was running money for a European company, investing in the US, but leveraging that international reach and really the strategic capability of Telefonica, which frankly, you know, in a very competitive market, I thought was a huge edge to be able to say to, you know, growth company XYZ, you know, we can open up big sales channels for you in the UK, Germany, Spain, et cetera.
Yeah,
And so, you know,
Telefonica is number 1, 2, or 3 on mobile as an MNO in 23 countries, I think. Right? I mean, that's a monster.
yeah,
If
absolutely.
the internet's on the mobile
Absolutely.
phone, you know, that's got to be a good move if you can get them to actually do something.
Yeah. I mean, Telefonica had about, I hope my numbers aren't stale, but they had 3 times the subscriber base of AT&T globally across the world. Now, different customer mix and different products, but still the reach was massive. So just I think the light bulb moment for me was being in the Valley, meeting companies, being able to have, you know, that behemoth behind you, and the capability of distribution and a sales platform was super powerful. And then my business partner kind of looking at it from the other direction, saying, you know, how can we think about some of the best industrial partners in Europe and use this as a way to really crack open Silicon Valley? Because, you know, the reality is you can scale in the US for quite some time without having to think about international. And then, you know, this is the easiest market to raise capital in, easiest to get large reference customers or a big consumer audience. And you could do a lot of things in the US where there's an advantage or you know, a lack of a necessity for US companies to think outside of these 4 walls initially. So long story short, the thesis we came up with was basically to do a bit of both. So we're investing in mid-stage venture-backed companies here. You know, it's growth. It's everyone has their own definition. It's really kind of B's and C's and D's for us. And looking at companies that have basically, justified themselves from a financial point of view. They are very, very high growth, but there's real, multi-million, tens, 20, 30 million revenue levels there. And what we're really saying is, can these businesses not only lead their space or lead their category or define some very, very large category and win share, but could they also work international, and could they win international? And then that is the entire dialogue we have with founders. So, the strategy we raised around the fund was effectively all US investing, some international when there's compelling cases. And then our LP base is entirely European. And they're all what I describe as strategic in nature. Majority of them very, very large scale families, private families, but families ultimately that own multi-billion-dollar enterprises across industry. There's some corporate LPs, but they're a bit smaller on the laundry list. But also, look, it's all additive to the thesis.
Wasn't ProSieben there from the beginning, and wasn't that the 7 is the Sieben?
Yeah, absolutely. So ProSieben was an early partner in the fund, and actually, there's quite a long-standing relationship there.
Actually, it acquired ProSieben. I never knew about that, but
yeah. KKR and Primera did a buyout of ProSieben in 2006, and they were in it for a while. Okay. And ultimately, the strategy of the fund and with the portfolio companies is all of our LPs can be their partners for internationalization in Europe. So they really reach across continental Europe, touch a variety of sectors. We mentioned ProSieben and the media footprint, but we have folks who are in shipping and logistics, in pharmaceuticals, in real estate, industrials and chemicals. It really is, frankly, everything non-digital. And that's ultimately our strategy. So we've now, we raised the first funds. We're sort of just under 100 million under management, and we're getting to the point where we've almost deployed it all. So we have to think about it all over again, as well as some other interesting projects we're cooking up.
Yeah, well, hopefully all of these LPs realize that tech is touching every business out there. And if they don't begin to digitize themselves and automate and bring AI into their business and perform functions better than the human could do, that they could be left behind. And maybe that relationship with you can pair the startups with them, and they'll keep re-upping, and you'll be blazing out a fund two sometime next year.
Well, knock on wood. No, but without a doubt. I mean, as you said, look, everyone is obviously invested for, financially incentivized, and that's why we're all doing this ultimately. But I think, what we've found is there's a huge appetite and curiosity and necessity to have a more ingrained introduction and relationship with digitally native businesses if you're coming from a completely offline sector. And it's not surprisingly, it's something everyone thinks about, and everyone wants more direct connectivity to the Valley.
Yeah, well, listen, preaching to the choir here, my old friend. I mean, I couldn't agree more that these large corps should use venture capital as a weapon to get business intelligence, and then them, and you can find suitable startup partners to bring to them and help them survive and benefit. And maybe on closing, so early on, you guys made some fund-to-fund investments too. So it was fund-to-funds, cherry pick, some secondaries, get on the cap table. How did that come together with the investing in funds and direct into startups?
Yeah, look, Andrew, it's opportunistic. And again, I think we'd like to be a bit contrarian with some of these things as far as the structure. We had a unique opportunity to pick up a couple of LP assets in really top quartile, early stage, fantastic guys. Part of our thesis was, a small bet here in amazingly performing managers is a differentiated growth funnel. And that's played out a bit. And then, mostly we do sort of direct growth down the fairway. I mean, we'll look at things from a few different angles, but the thought is, the only way to really generate high DPI and kind of outsized performance is with a relatively concentrated portfolio. And if the asset quality is extremely high, I don't really care if we're going through the front door, the back door, the side door, whatever works to kind of get to that point of view is how we've approached it.
Sounds good, my man. Well, listen, great to see you over the Zoom here. Hope to see you in the real world soon. And I'll talk to you privately very soon. Take care, my friend. Thanks for joining.
Likewise, Andrew. Thanks so much. Great to chat.
Okay. Take it easy.
Cheers.
Bye.